this video finds you well. Rich Krafcik with Cobblestone Asset Management. Right now, I'm finding myself having similar conversations and recurring questions are coming up around a few different topics. My team and I are spending a lot of time on these topics, and I'm hoping it'll be useful to share some of this with you and just keep you up to date on what we're watching, what we're seeing in the world, and where things may go from here. The first topic I want to touch on is consumer sentiment. I wrote an article in January of this year, and one of the key themes that I thought would play out would be an improvement in consumer sentiment. So if you look at the chart, there are some clear highs and lows in the consumer sentiment index. This has been tracked since the early 1970s, so we have a good bit of data here. And historically speaking, the market has performed better over the 12 months following the low in sentiment relative to how it performed in the 12 months following the highs. If you think about this, if sentiment is already overly optimistic, there may not be much more room for improvement. Conversely, if investors, companies, and the general public are overwhelmingly pessimistic, then there oftentimes is a chance for some outperformance or at least beating the expectations. So if you look at that low that we saw in June of 22 and the improvement since then, much of the market rally can be attributed to the increase in sentiment. Moving on, let's talk about the Federal Reserve. They've been in the news quite a bit, and they have two main mandates. One of those is for a stable US dollar. Now, there's been a lot of government spending leading into this current economic cycle, and a number of reasons why. I'm not going to get into that. But the reality is some of that government spending has brought on more inflation than we would like to see. So as a result, the Federal Reserve is using some of their policy tools to try and combat inflation. Take a look at this chart, and what you're looking at here is the federal funds rate. It is the one interest rate in the economy that the Federal Reserve has direct policy control over. So I do want you to understand, when you think about the yield curve, the cost of borrowing money from overnight all the way out to 30 years and beyond, every other point on that curve is influenced by market forces. But this overnight rate, which is the rate that banks lend to each other on an overnight basis, is directly set by the Federal Reserve. So if you notice here, we start just before April of 2021. It's a flat line for quite some time. The Fed started to increase rates. So look at that inflection point shortly after January 2022, and it's continued, right? So from January of 22 through today, we've seen a rate that was effectively at or slightly above zero to now a Fed funds rate north of 5%. So on one hand, this is an effective tool to slow down the inflationary pressures. We're raising the cost of borrowing money on an overnight basis. In turn, interest rates across the economy have seen increases. You look at a 30-year mortgage today compared to where it was 12 months ago and 24 months ago, it's a noticeable change. Now, I will show you one more chart. I'm going to give this to you from a wider historical lens, just so you can look at the Fed funds rate over history, because yes, rates are rising off of a near zero, but historically, we've been here before. Now you're looking at the Fed funds rate from 1955 through today. The increases that I just spoke about, you can see those all the way to the right of this chart. From a historical perspective, we have been here before. So there have been many other cycles where the Fed has had to increase rates, and we've dealt with rates higher than this. For those of you that borrowed back in the late 1970s or early 1980s, if you remember some of the rates you were paying, today looks like a bargain in comparison. So the Fed funds rate is a policy tool. It's being used right now. It's been used before, and the market can continue to thrive under these circumstances. So the chart in front of you tracks inflation. We have it color-coded so that blue indicates low inflation or even deflation. Red indicates high inflation. If you look at 2020, we had a global shutdown due to COVID, and this put quite a bit of deflationary pressure into the economy. Central governments, politicians around the world came together and provided quite a bit of stimulus, and when they did that, it led to inflation. So you'll see the red come about almost on a global basis in the quarters that followed. And I'll point out that each box on this chart represents a 3-month period, so 1 quarter. Now this is year over year inflation readings. So we compare how are prices today versus a year earlier. We can look at this and say that Federal Reserve policy is helping. If you notice, the darkest red happened in early 2022, and since then we've been seeing better year over year readings each quarter as that data comes in. Up till now, I've been talking about some of the conversations that I'm frequently having. I want to pivot to some forward-looking thoughts here. So on your screen, you're looking at the S&P 500 earnings expectations. And this is provided from Yardeni Research. If you notice, we have the purple line, which is a 52-week earnings figure. We then have in green the 2023 figures, red 2024, and blue 2025. 2025 has a projected EPS or earnings per share of 270 points. Compare that to 2023. That's 45 points of earnings growth. That would represent a 20% increase. Notable, and it would be a very nice outcome for the S&P. But the reality is, when we choose to invest in the stock market, we're inherently taking some risk. There is no guarantee that this earnings is going to come to fruition. There are a lot of factors at play. So what we're watching closely here is going to be some of the consensus estimates. And that consensus comes from a combination of analysts and also from company guidance. If we see companies guiding lower and analysts revising their expectations down, we're going to be keeping a very close eye on the verbiage. What are the factors that are driving these adjustments? And is that something that's likely to continue? And if so, we'll be taking proactive measures to trim risk. Now, I'll tell you, every day when we wake up and choose to invest in the market, we're inherently taking risk. It's not something to be afraid of. I just want to point out, in a situation where the Fed is actively trying to cool inflation, we have to be aware of the growth potential and carefully weigh that against some of the downside risks. In our view, the balance still makes staying invested worthwhile. History points to that. And if you have any additional questions, reach out. We'd certainly like to talk to you about it.